It seems that nothing can save Alibaba and its falling stock. The stock is now down 78% from its all-time high of late 2020 and is already at the bottom of a range started 2 years ago. Alibaba is now trading around 23% lower than the price of the first day the company got listed 10 years ago. And that's quite interesting because back in 2014, Alibaba used to bring around 10 billion in revenue and now it's bringing around 130, 13 times higher. Back in 2014, after direct cost of sales, Alibaba was bringing in just below 8 billion in gross profit. And now it's bringing just below $49 billion. Net income or the profit was 4.5 billion versus 18.5 billion now. And earning per share was just below $2 and now it's around $7. So all in all, the company is at least 3 to 4 times better, larger, more efficient, and yet 20% cheaper. But now let's look at its financials and see if there is any reason to be excited about Alibaba. With today's stock price of around $70, Alibaba has a market cap of 174 billion. They have around $33 billion worth of cash and 23 billion worth of debt. So the enterprise value is $164 billion. But Alibaba also has just below $80 billion worth of investments, which are pretty liquid, and I usually count them in as cash equivalents because they can be converted into cash pretty easily. With this, the enterprise value comes down to just $85 billion. So it only costs $85 billion to acquire Alibaba as a whole. Over the past 12 months, Alibaba brought in 130 billion in revenue and 30 billion in last quarter alone. And according to company's quarterly report, there was an increase of around 9% year over year. But due to the foreign exchange rate and a strong US dollar, in US dollar term, it was actually an increase of around 6%. Alibaba also reported 18.5 billion in net income or profit and 27 billion of free cash flow, which is basically the money that would end up in your pocket if you own the entire company. With these numbers, Alibaba is trading at 9.7 times its earnings. It is the cheapest price to earning ratio the company has ever had. And as a comparison, for example, Amazon is trading at around 81 times its earnings. So almost 8 times higher than Alibaba. Alibaba is also trading at just 0.65 times its revenue and only 3.1 times its free cash flow. So technically, if you own the entire company and collect only 3 years of free cash flow, you would break even. That is extremely low valuation for any company, let alone a player like Alibaba that has a big role in a lot of high growth industries. So far the valuation looks extremely attractive, but there must be a reason that the stock is trading this cheap. And of course, the biggest headache that comes with investing in Alibaba is that it's a Chinese-based company. And there are many good reasons for investors to avoid Chinese companies. Currently, many investors are worried about the hard landing of Chinese economy, which directly impacts Alibaba. And among other things, the main worry is that the Chinese real estate market is facing a tough time with all the problems around Evergrande, which we've heard over the past couple of years. And that is extremely relevant because it represents, the real estate market represents something about 30% of the whole China's GDP. And the second concern is that Chinese companies are known to be less transparent and less audited, which makes them riskier. And we all heard of what happened to Luckin Coffee, for example, 4 years ago. And nobody wants to experience the same thing with Alibaba or any other Chinese company. And on top of that, there are more political risks in China than in the US. For example, Chinese authorities have initiated a crackdown on its tech companies due to the concerns that giants like Alibaba simply have too much power over the population. And they have monopolistic behaviors for which Alibaba was fined $2.8 billion in 2021. And then the IPO of Ant Group, in which Alibaba holds a 30% stake, was also cancelled by the regulator. And then yet another drawback about investing in Chinese stocks is that China doesn't allow foreign investors to own direct shares in most of its domestic companies. So for example, if you want to buy Alibaba stock, you won't receive the ownership of the company. Instead, you receive something called a VIE or variable interest entity based in the Cayman Islands. And of course, that has a claim on the underlying asset, but there is still a risk that China might decide to revoke that claim. Alright, enough with bad news. I still think Alibaba is cheap considering all of those concerns. Not a financial advice though, but let me tell you why. The Hang Seng Index, or basically the index that tracks the price changes for the 50 largest companies in the Hong Kong stock market, has a 10-year median of 10.2. And now we are now below 7.8, and in the past 20 years we barely came this low. In short, I do believe that worst of the news have been discounted by the market already. We often forget that Hang Seng dropped more than 50% from their all-time high. How much further down can it go? And then while the United States is struggling with high inflation, high interest rates, rising default rates, and banks reluctant to lend money, China is currently in the opposite situation. Interest rates are declining and Chinese government is also poised to increase fiscal spending. The prime rate loan has already decreased twice in 2023, and since China is now fighting deflation and not inflation, I would not be surprised at all if rates were reduced again and fiscal spending increased. Alright, let's talk about the growth. As you can see in this chart, until 2021, growth never had any problems. And pandemic, fines, real estate crisis made 2022 and 2023 hell for Alibaba, and the company is coming out just fine. We went through the numbers earlier together. And also you should not forget that all of these figures were negatively impacted by the unfavorable exchange rate over the past couple of years. And as I have mentioned earlier, the company is far too undervalued. Only Prosus is cheaper than Alibaba in terms of PE non-GAAP and even forward GAAP PE. Alright, let me show you Alibaba's earning per share trend over the past couple of years so I can tell you another reason why I think Alibaba is cheap. But you see, a stock price usually follows earning per share, and over the past couple of years, earning per share in Alibaba has been increasing while the stock price has been decreasing. So this gap needs to be filled somehow, and it's usually in history by the stock price going up. It gets even more interesting if you compare the cash flow yield to the stock price, and then you see that they're going into completely different directions. And the cash flow yield has had quite a healthy growth over the past couple of years, and I can see that trend continue over the next couple of years. And yet another bullish chart. You can see in this one that the shares outstanding are decreasing. This is a very positive news for investors that Alibaba purchased $9.5 billion worth of share buybacks in 2023 and plan to continue that until 2025 with yet another $12 billion. So all in all, my take only and not a financial advice, the stock is certainly cheap and should perform better in the future. But I think Alibaba has just been satisfied with their past successes and not trying too hard for the future. But these are the risks that comes with Alibaba that nobody mentions. So thank you very much for watching all the way to the end of the video. Please let me know which stock do you want me to cover next.